By the end of June, this company had earned $1.3 million net income. Their cash balance, $484,000. Now, before you say, well, obviously they spent it somewhere, they didn't. No big equipment purchase, no crazy payroll, no owner taking money out. The business ran exactly as it was supposed to run. So where'd the $800,000 go? I'm Mike. I spent a long time as a controller at an aggregate mining company and handled a variety of things there, from just general accounting to all of the FP&A operation. Now, the single most common financial crisis I saw, whether it was at that company or one of our competitors, customers, or vendors, wasn't bad management, wasn't a bad year. It was a good business slowly bleeding cash away in ways nobody could see. Today, I'm going to show you exactly how that happens using a real set of financials and why your P&L is hiding it from you. I want to walk you through 5 things that drain cash from a profitable contractor. And the reason nobody talks about them is that none of them are mistakes. Every single one is a result of reasonable, normal business decisions. That's what makes this so dangerous. So the first mechanism is the ARAP spread. 30-day gap means roughly $1.8 million is permanently floating in the pipeline between work completed and cash in account. That gap alone, the ARAP spread, is the single biggest structural cash drain in the contracting world, and it gets wider during your busiest months, which are the exact same months you need that cash the most. Mechanism 2 is retainage. Most commercial construction contracts allow the owner or GC to withhold, somewhere around 10% of every payment until the job's complete. Here's what contractors miss. On a good year, your retainage balance can grow to nearly equal your total net income. Think about it. If your net income is 10, 12, 15%, all of that money is going to be tied up in retaining. It's an asset on your balance sheet. Your accountant isn't scared of it, but it's completely inaccessible until the job closes out. By September, in our example company, they had $1.3 million sitting in retainage receivable. Their annual net income was $2.6 million. Half their profit was locked in a waiting room with no checkout time. Mechanism number 3 is the growth trap. This one is the most counterintuitive. A busy season is supposed to be good, and it is. On an income statement, it's great, but here's what happens to cash when revenue spikes. Your AR balance grows because there's more invoiced and uncollected. Your retainage balance grows because more commercial work is billing. Your vendor payments go out immediately because you need the materials and subs to do the work, and your payroll goes up because you hired more crews to handle the volume. Every dollar of new revenue you add in the busy season requires roughly 50 to 60 cents of working capital to service it before a single dollar of profit hits your bank account. The more successful your spring and summer, the more cash constrained your July and August will be. The P&L is going to look incredible. The bank account is going to tell a different story. Now, mechanism number 4 is underbilling. This one happens in almost every contracting company with more than one project manager. The residential PM is great at the work, but every month the invoices go out 2 to 3 weeks late. The costs happened, labor, materials, subs, but the billing hasn't caught up yet. That gap shows up on your balance sheet as costs in excess of billings. It's money you've spent that you haven't invoiced yet. In our example, this stays manageable, around $50,000 to $56,000 at peak, but I've seen this number reach 6 figures at companies that had no idea it existed because nobody was watching it. Every dollar sitting in cost in excess is a dollar you funded out of your pocket for work you've already done, waiting on an invoice your PM hasn't sent. Now, mechanism number 5 is equipment loan principal. This one's quiet, but it's merciless. The interest on your equipment loan shows up on your income statement. Right there, you can see it. The principal payment doesn't. It goes straight to the balance sheet. So every month, whatever it is, $8,000, say, leaves you the bank account. So every month, $8,000 leaves the bank account, reduces the equipment loan balance, and never touches the P&L. Over a year, that's $96,000 that simply doesn't appear anywhere in your profitability picture. It's not a big number individually, but combined with the other 4 things we've talked about, or a variety of other equipment loans or leases, it's the last straw on a camel's back, and that camel's back was already overloaded. Now here's the thing that's really going to land when I show you the data. Not one of these 5 things is a bad decision on its own. Paying vendors fast builds relationships. Taking on more work in the summer is also the right move. Retainage, contractually required, you're not going to get around it. Equipment financing, it's how you're growing. Billing 2 to 3 weeks late isn't great, but it's not catastrophic. But together, in the same month, or for a long period of time, back to back to back, on a company with no cash visibility, they turn a healthy business into a company that can't make payroll in June on a year where they earned $1.3 million. All right, let's take a look at Ridgeline Contracting Group. They do excavation, concrete, and residential. About $16.9 million in annual revenue. Take a look at the numbers. Gross margins over 30%. Net income 15.5%. That's pretty strong. Revenue is also going up year over year. This company's performing. And that's exactly what makes what I'm about to show you so important. All right, now here's where we can really start to see what's going on. This is a cash reality report. It's the bridge between net income and actual cash. Watch what happens when you walk down from net income to cash. Here's our net income. We got $1.2 million in the first 6 months of the year. Now, on top of that, we're going to add back some depreciation. So there's some cash we get back. Depreciation is a non-cash expense. It goes on the P&L, but we don't actually pay for it. We're paying for it as we use that machine sort of symbolically, but we get to add back the depreciation. Now, here's where it really starts to hurt. Accounts receivable. We already talked about how much it hurts to have those long AR days. Accounts receivable is causing a decrease in our cash balance of $2.6 million. Now that's all that retainage sitting on the balance sheet that we haven't collected for and probably won't for a long time. That is our long AR days killing us. Next, other working capital items. This is accrued liabilities, prepaids, credit cards, that kind of thing. From this, we actually added back another $500,000 over this time period. But who knows if that's all good. Credit card balance could be maxed out. With prepaid expenses that aren't really going to affect cash in the future, but are already paid for in there, those kinds of things. So take this one with a grain of salt. Looks good. Potentially there's some issue there. Then debt repayments. So we talked about it before. This is that principal payment that's coming out every month. We see the interest part. We don't pay attention to the statement of cash flows. Here is how the payments on that equipment is affecting your cash. Then it all comes down to the net cash change. So over the course of the first half of the year, we've decreased our cash by $435,000. Where did all that go? It's right here. You could argue there's some other spots here, but looking at this AP is a big one. So now we see we're running through our cash in the middle of the year. Hopefully it comes back around. Maybe not. Our cash runway is set at 6 months right now. It means at our current run rate, current business operations, projected out, we could last 6 months before we have $0 in the bank. It's a big issue. Now here is the number that I want every contractor to know by heart. It's the cash conversion gap. This is DSO, day sales outstanding, or AR days. This one here takes out your retainage. This one has it in. And then we have DPO or AP days. This is how fast you pay your vendors. Now you can see here, over the course of the year, we have a 15-day gap between the two of them. Now, the business didn't change, the contracts didn't change, vendors didn't change, but as revenue scales up, that gap becomes worth more and more and more, and it becomes far more important to the continued operation of your business to manage it. This is what I mean when I say the AR-AP spread is structural. It doesn't require anyone to do anything. It's built into how the industry works. The question is whether you can see it and act on what you're seeing. And here we have retainage receivable. Look at that line. January, you're down at $175,000. March, you're up to $388,000. June, $848,000. And then September, $1.35 million. It looks like an asset, and it is an asset, but an asset you can't spend. And it nearly equals half the company's annual net income by the end of the year. Here's the dangerous assumption contractors make. They say, that'll get released when the job's closed. And it will. but jobs closed in October, November, December, the same months, revenue drops. Now here's what you actually need. Cash balance, a cash timeline. This tells you in January that June is going to be tight. Not a crisis, but tight. You have 4 months to do something about it. You can, do anything. Pre-negotiate a bigger line of credit before you need it, not after. Talk to your top 2 GC clients about tightening payment terms. Even getting one of them from 52 to 38 days is worth $200,000 in June. Get invoices out this week. Slow down your AP a little. Instead of 22 days, pay 28. Your vendors probably won't really care. Your bank account will. Any one of those moves alone changes the picture, but you can only make them if you can see what's coming. Now, obviously, this projection looks pretty good. That's because it's put together in a way that they're building cash. We added profitability, those kinds of things. But without this picture, who knows? We could run out of cash in March of next year. So this is a big, big deal. So let me give you the 3 things to take. Number 1, your P&L is not a cash statement. $1.3 million net income, $484,000 in the bank. Same company, same 6 months. The P&L is measuring performance. The bank account is measuring survival. 2, the cash killers are structural, not behavioral. Now, that's not to say that there aren't behaviors everybody can change in their business. But in this case, nobody did anything wrong at Ridgeline. They grew. They paid their vendors on time every time. They signed standard retainage contracts. Each decision was reasonable. Collectively, they created a company that's $800,000 cash light on one of its best revenue years ever. The only way to manage structural problems is to measure them. That means tracking DSO, DPO, retainage, work in process, and cash timeline, not just revenue and net income. Now, the 3rd, visibility is the intervention. I said earlier that any one of our 4 moves could have fixed June, but you can only make those moves proactively if you know what's coming. The goal isn't a perfect cash position. It's no surprises. A CFO who sees a June squeeze in January sleeps fine in June. A CFO who sees it in June doesn't sleep at all. Now, the company I showed you today, Ridgeline, they're actually in fine shape. They'll collect that retainage in Q4. AR will recover. They made good money this year. But I've seen versions of this story where the retainage is on a 2-year project, where the GCs are at 75-day terms, where the PM isn't just a few weeks late, they're 2 months late on invoices, where there's a second equipment loan. Any combination of those, and June isn't just tight. June is payroll calls on a Friday afternoon. Now, if you want to see this for your own numbers, your own DSO, your own retainage curve, your own cash timeline, Finance IQ has a free trial link below. Upload spreadsheets of your financials and you'll have your own cash reality report in about 10 minutes. I'm Mike, and next video, I'm going to show you how to analyze an equipment purchase decision the right way. NPV, net present value, internal rate of return, and lease versus buy, and why the way most contractors think about equipment is costing them money they don't know they're losing. See you then.